Do you follow Bapcor at all?
Stock tanked? Is that
Tanked, yeah. About 30%. New CEO in the last 12 months, but also the announcement of Bunnings.
Oh, car parts too.
So you can go and pick up your floor mats, your oil, etc., from Bunnings now. The tariffs in South Korea has been hit with 15%. India has been slugged. He has escalated with Brazil, I think up 40%. The National Australia Bank CEO getting called out to maybe ease up a little on the old Henschke Hill of Grace at client functions. When you're at client events, Drew, how many's too many? Drew, Meredith, welcome to my first ever 2 Cents podcast. Owen, our fearless leader, is still under the weather, and I know Owen is genuinely sick when I just do not hear from him.
Same. I thought he was ghost. He'd ghosted and just disappeared.
I thought I was on the outer.
I think everyone did, because he's so quick on the text and on the banter. And then you said, I think I sent through a copy of the the $10,000 portfolios to him. Got nothing because I was winning, so naturally he usually wouldn't respond when I'm beating him. But I think after 3 messages, I sent him late Friday night, maybe after a tipple, said you were live. At that point, I think it was 3 days, but yeah, it must be super unwell.
Yeah, he must be pretty out. Either that, or I'm completely on the outer. Owen's been very under the weather, so I am stepping in. I'm Owen Light for this episode. So for those who actually don't know me or don't know my voice, I'm Mitchell Sneddon, head of funds management at Rask. I take care of the Rask Invest side of things. And this is the first time me and you, Drew, have actually done one of these together. We bump into each other in the office regularly. This is the first time behind the mic. So plenty to talk about today. The tariffs are really ramping back up in the US. We've had results from Meta and Microsoft. We've got some more entertaining news.
Some inflation data this week, not inflammation data.
Drew's inflammation data is back from his doctor.
Similar vintage, so maybe inflammation is the right topic for us. That could be for the Australian Retirement Podcast, though, maybe.
I'm 40 this year. I don't know what you're talking about.
You're 42. There we are. 2 years apart.
Okay.
Yeah.
Okay, buddy, a little bit of a ways off from the retirement podcast for me. Let's talk about the tariffs, because I'm actually really interested to hear your view. Just before we came on, I've seen South Korea has been hit with 15%. That he has escalated with Brazil, I think up 40% now. India has been slugged 15% today as well. I'm interested, though, because a lot of this is just used as a bargaining tool. They'll probably, especially the India one, because India still purchase a lot of their weapons, armaments, and energy from Russia. So that's definitely a bargaining chip there. But I'm interested what you do, Drew, from a perspective of, because your clientele at Wattle, they're predominantly retirees. Have you actually altered your portfolios at all given this? Because from our perspective, where we maybe have some younger investors, it's very much a, hold the line. We're happy to be holding the sorry, my cat has just jumped up for the first time in this podcast. It won't be the last time. We're happy to hold the line with our IVV investments and whatnot because we have an incredibly long time frame. Your clientele, that time frame's different. So how are you managing that?
I'll be blunt and say that if we were changing it significantly when the tariff announcements came out, we were doing something wrong before. Like all our clients and what we talk to clients about, but I think all of our clients want, as you said, is a finite pool of capital. You can't put any more money in when you get to retirement, is resilience. So that's income and growth resilience. So you don't want to be reliant on just one sector, one economy, one company, essentially too much, because if you permanently lose capital once you've retired, it's very difficult to get it back and takes significantly longer. So we didn't change. So we had an investment committee the day, Liberation Day, immediately, like an emergency investment committee outside of our monthlies, and ultimately made the decision not to do anything. In hindsight, recovered in like 3 days. So there wasn't a lot of time to execute anything anyway. But I think the big thing we see is that if, like what we're always trying to do is ensure that if a major shock happens, there'll be parts of your portfolio that do well, there'll be parts of it that naturally do poorly. But as a whole, it's going to continue, plodding along this normal, consistent return path, and the income's going to keep coming. So yeah, equity markets fell. Our bonds did well. Our gold and alternatives did well. Real assets did reasonably well. So it was kind of this, equities fell heavily in a few days. And I wish in hindsight what Owen did when he told everyone he was putting 100 grand in the market just kind of killed us all, I think. But we've always got a backup. So whether it's cash, fixed income, alternatives to sell and put into equities if we think something significantly bad's happened. But we're building portfolios for 10, 20, 30 years, but also to be resilient from those shocks. So I think it's similar. We take, you talk about long-term view, and all we're trying to do is dampen the volatility, because we know S&P 500, IVV, IOZ, all these ETFs dropped very heavily in 3 days. And for us, that opens the risk of emotional decisions with a finite pool of capital. So it's how do we avoid those? And it's to dampen the portfolio impact as opposed to this single stock impact.
What exposure, generally speaking, because I'm guessing it'll change from client to client and model to model, what general exposure do you have to the US in the Wattle portfolios? And how do you go about getting it?
Yeah, perfect. Great question. We do. So if you think about a balanced growth portfolio, you're talking about 70% in growth assets, including equities, and usually about 15% of that 70 is in alternatives and real assets, which leaves 55%, which means 27.5%. We split our global and domestic evenly. Okay. Retirees get the benefit of franking credits, higher income in Australia, but we want the growth from overseas. So about 27.5% of portfolios are in global shares, and about, I can get into the detail. We've got some GitHub set up with all this Python coding behind it, but it's around 80% would be in US shares, 20% in emerging market in Europe. But within that US shares, we're not just in, IVV, the big companies. We're in small caps, we're in mid caps, we're in different sectors.
You get that exposure through funds?
Yeah, we do both. Yeah, so we run a dynamic model, so just ETFs. And then we have a core satellite model. That's about 50% in ETFs and low cost. And then we use active managers. I know we get these questions all the time. We use active managers to diversify that, because we know if you just hold one ETF, you get a lot of exposure to just a few companies. So how do we add an exposure to small caps, the other drivers in the economy, or how do we add an exposure to Asia? And in most cases, we like doing that through an active fund. But then they tend to, because they're when you look for an active fund, you know something like active share. Basically, we want an active fund to be different to the index, which means
if you're paying them to be different, you want them to be different.
Yeah, in some cases it doesn't work the right way. There's a big, very popular fund that's underperformed significantly this year, and I kind of see it as being that's kind of what you pay them for. If you just wanted the index and for it to keep tracking the index, then why would you pay that fund manager to do it? But that's, if you follow GQG closely, their global equity exposures their main fund has underperformed over the last 12 months or so. Their headline company, I think, is still doing reasonably well.
Is that, I get GQG confused with one other one.
GCQ?
Yeah.
Doug Tynan, I think that's Doug Tynan, GCQ, and GQG is the big global manager who has something like
Sanjeev Jain. Billion. Is that?
Rajiv Jain, yeah.
Rajiv Jain, sorry. Yeah. The other one, GCQ.
Yeah.
I was lined up to interview, not Doug, Chris. Chris Prunty. I was lined up to actually interview him for the Investors podcast, but he actually ended up cancelling his trip to Melbourne, which was a shame, because he's been one of the best small cap managers in Australia for a very, very, very long time.
So a really good story on there too. But that was, So, but why did they underperform? And there's usually a question around this because they were significantly different. So when Liberation Day came, they went very defensive and stayed defensive. They trade a lot, so they're moving in and out of different sectors. So, but if I wanted, we've already got the S&P 500. So if I knew they were just going to stay in the S&P 500, I probably wouldn't use them as much. And I see to a point, underperformance is okay if they're doing something different. Whether it's sustained and they start missing the trends, the changes that are occurring, then you get concerned.
Other big news out overnight, I completely forgot to lead off with this, was the US Fed kept rates on hold.
Yeah, that was and we had inflation data in Australia overnight too. And I remember right before we went to the last episode of 2 Cents that went to air, I made a pretty big call that they were going to cut. They did not cut. I think this is the follow-on, and it clearly is the follow-on of Trump and the tariff announcements, that everyone's kind of in this pause mode because they're not sure.
Yeah, definitely wait and see.
Yeah.
I think the expectations were for Powell to hold the line. 2 members of the committee voted to cut by 25 basis points, but they were expected to do that. Apparently, they put up very logical reasons as
Rates
to why.
High, Trump asked us to. Is that it? Trump tweeted us.
Yeah, Trump slipped into my DMs on Truth Social. Have you ever been on Truth Social?
No, I haven't. I've barely been on X, so I couldn't.
I'm not a social media guy either. But geez, I reckon Truth would be the Wild West. Hey? Like if you're not keen on X, my lord, that would be something.
I think everyone's freaking out. No, they're not freaking out. They're just on pause mode. No one knows. I listened to the Compound and Friends and Animal Spirits quite regularly, and they were saying. So I think they had an expert on there that was like the amount of money actually raised from tariffs since they're announced versus last year is barely changed. It's like $40 billion or something, and it was $40 billion last year, and it could increase. But if it increases to $80 billion, like what Trump was planning, that's not a significant drag. Like that is, it sounds a lot worse in theory than what the actual implication is. I found that kind of super interesting considering, we didn't touch on it, but the taco theory, which...
Well, I think taco theory also...
just a negotiating tactic.
It's a negotiating tactic, but also Trump becoming aware of taco theory puts taco theory at risk of not happening again because he's like, rightio, I'll show you.
The cry wolf, the story. Yeah,
exactly. That's exactly what. Speaking of taco theory,
being Trump always chickens out. It's not. Making sure it's not. Sorry for that. Anyone who does not know, understand, isn't up to speed with taco theory. But then we do actually have a question, which I'll get to when we get to the listeners' questions about Guzman and Gomez. So that rolls neatly into taco theory. Let's have a look about what's been going on domestically here. I want to understand, Drew. Actually, this question leads into this one as well. Where were you on the night of the 2nd of July? It was a Wednesday night. Where were you? And what night was it?
2nd of July, Wednesday.
This year?
Yeah. I'm not good. No, 2010.
I check my calendar?
On a Wednesday? Sure. Check your calendar.
Oh, if it's on a Wednesday, I would have been putting my kids to bed, hopefully.
I can tell you where you weren't. You RSVP'd to our end of financial year drinks.
Oh, did I?
And did a no-show.
Really?
Yeah.
I'm quite bad at that, to be completely honest.
It
looks good in theory. Was that at...
It was 100 meters from your office. We did everything we could.
Where did you do it?
The rooftop of the Duke.
Yeah, did you? Oh, yeah. But did you send a calendar appointment?
Yeah, I would have.
If it's
so for listeners, I am 50% of the Rask Group social committee.
Yeah. Who's the other 50?
Sophie.
Oh, all right.
Yeah.
Not Owen. I was like,
he's not
the social person.
Owen's the last person you want running your social committee. Trust me.
Surprised I missed that. Yeah.
If Owen was running your social committee, he'd just be like having one of those, those public barbecues down by the Yarra. So I could just buy some sausages. Going, here we go. Come on.
We've all got a mate that does that.
So yeah. you weren't there, but this question does lead into it, just having a few drinks. When you're at client events, Drew, how many's too many?
Client events?
Yes.
Yeah, so I usually go almost deliberately drive. If we're at Wattle, we run a Wattle Day, which is coming up soon. We used to do it in the Yarra Valley.
Not received an invite to Wattle Day, just everyone, FYI.
I mean, yeah. You're a bit young, maybe. We do only deal with retirees, unless you're retiring early, or some accumulators. I think it's as many as you can drive. I'd say 0.05 should also apply to work social events. For the primary, the 70, 80%, you're gonna get me somewhere here. The first kind of 80%, once the formalities are over, go for it. Go, but don't drive. Yeah, go for that.
Well, this is leading into, of course, the National Australia Bank CEO.
Oh, yes.
Getting called out supposedly by a quite a large fund manager and that fund manager going directly to the chairman of NAB to get the chairman to tell Andrew Irvine, the CEO, to maybe ease up a little on the old Henschke Hill of Grace at client functions.
It was this client, yeah. I mean,
I've never heard that come out in the media.
Particularly for like a top 10 company.
Top 10 company, the CEO being told to maybe steady on.
Yeah, I find it, one, like the fact that you're drinking enough that people would comment on it, whether it's a hit job or not, whether someone's trying to kind of take him down. It doesn't seem like that. But I think the perception in leadership, and I think in most of the cases, is that particularly like Christmas parties, we do that all the time. Like my staff don't want me around on the Christmas party. They don't want me on the dance floor. It's like, no, just have a couple, go home, let everyone else have fun. That's the way it's supposed to work. That's been my approach majority of the time. And I think, if it's someone's noticing it, then I think you're pushing the boat out, or pushing it a little bit too far. I find it's something you do more privately, as in, if you want to really indulge in a Grange or a Hill of Grace, do it at home. And coming late, don't do it at your desk.
Don't do it at your desk. I'm sure he's not sitting there at his desk having a quick nip.
We never know.
But
how do you feel about it?
I was quite shocked that it actually came out. I have never actually heard this before in the context of an ASX top 20 company ever. Maybe I just don't roll in those circles. I mean, I'm clearly not at these meetings. But I was very, very surprised. But I'd be certain that old Andrew Irvine will be on the waters.
You can make it a vodka soda. Just make it look like water. It's fine.
Yeah, there you go, Andrew. Tips from
drink.
Drew.
I'm always choose your drink too. Like if you're in a formal environment, and you're the CEO, don't have a beer.
I'm sure he's not pounding tequilas.
But if you're in a country pub, where I think he was, and then apparently there's comments on Facebook, they're all misspelt or something as well. So
I didn't go that deep. Did you troll his Facebook account?
No, Rear Window. Rear Window is always where the news gets broken. He posted about around 10 p.m. local time, no doubt to his surprise. So did Irvine, with some typos. I enjoyed meeting you and many other customers in Townsville. Such a vibrant economy. The biggest obstacle, misspelt, is lack of staff. So much opportunity for people in northern Queensland.
Clearly not lack of staff at the bar, because they were able to feed those drinks up thick and fast.
It's hard. You've got to have really thick skin in any sort of public leadership, I'm sure. And that's why there's probably a question about that coming up too. But we talk about salary, pay of big leaders and big CEOs and how overpaid they are, but you're putting yourself out to
expectations come with that.
Yeah, exactly. Expectations come, but you're also in the public eye all the time.
The CEO of a Big Four bank, the amount of power they would wield in Australia, it'd be...
You don't want to be seen,
Yeah. You'd probably have more power than the Prime Minister, really. So... Speaking of,
you're really giving me the hard questions today too.
Am I? I'm not soft touch Rask. Let's have a look at, speaking of new CEOs, WiseTech has got a new CEO. What do you make of this one, Drew? A little left field. I've just done a little comparison of his pay compared to other CEOs in the vicinity of the market cap region. I believe he's on just over $1 million a year. Suncorp, I think, is either just above in market cap or just below WiseTech, and their CEO's on about $6 million a year. So maybe you get what you pay for. But what can you tell us about WiseTech's new CEO?
See, I don't follow this company that much. I followed enough because a lot of, Owen's been a long-term kind of proponent, I think, and Rask has, and a lot of people we meet with have WiseTech shares. So I don't follow it that closely, but it seems we talk about, and it used to be popular, it's gone away now, is ESG, environmental, social governance. And, this where fund managers, ETF, everyone was talking about the ESG, and this is clearly a G, governance. And it just shows you how difficult I'd suggest, there's still major investors all over WiseTech. It's one of the biggest companies in the world. They don't really have a choice. But the governance, so it sounds like he has employed someone that worked for him 10 years ago as CEO, but whose recent jobs aren't necessarily comparable to the CEO of one of the 20 biggest companies in Australia. 20 biggest? 20, 30 biggest?
The resume lacks a little.
Yeah. As far as we know. It's being reported as kind of a way for Richard to retain his power or to have some input over the CEO as from his position as, I think it's executive chair these days, and as he transitions out. But who knows if that's actually the case? But it's been reported as kind of this protecting his position, and that's where the questions around governance and whether the board has any say or control over what's happening at this company.
Another company...
Is that a politically correct way to answer that question?
I think you did very well. I don't think Mr. White is a frequent listener of 2 Cents. So
you never know.
To be fair, he has been on the podcast before. Owen has interviewed him. Have you listened to that one? It was quite a good interview.
No,
it was a long one.
I might go back to it now.
Yeah, let's see. It'd be interesting to see how it's aged, given what we now know. Right, moving on. Do you follow Bapcor at all?
I have a 4-wheel drive, so I should.
Yeah, you do. Yeah, you do. I'm a listener of 2 Cents, so I feel like I know your lifestyle quite well. You swapped the Porsche for a Prado. Is that correct?
Yeah. The Porsche didn't hold on to its value as much as I would have liked. So,
you haven't sold it yet?
Not yet, but on its way out, just kind of sitting there in the.
What does a second-hand Porsche go for?
Yeah. At trade-in, not much. Not as much as the lease on it at the moment. So I'll be patient on that one. It's cheaper to keep it. But yeah, we got the Prado. We've done nothing aftermarket, though. I was admiring another Prado that was in the in traffic this morning, coming up the Eastern, which had the roof rack, had the bull bar on the front. Looked nice. But what's a stock tanked? Is that
tanked? Yeah, almost about 30% down
in the session.
Yes. So basically, new CEO in the last 12 months come in and has done what a lot of new CEOs do and clears the decks.
Yeah,
so to speak. A lot of write-offs, etc.
Reset earnings expectations.
Exactly right. But also, headwind that it's facing, and this is interesting, is the announcement of Bunnings.
Parts too.
Car parts, yeah. So you can go and pick up your floor mats, your oil, etc. from Bunnings now. Look, I don't know where they're going to put it in the Bunnings store. I can think of like they may as well get rid of the Bunnings cafes.
So they're getting bigger and bigger.
Talk about wasted space. The cafe in a Bunnings. Have you? Jeez, they're grim.
You can never find it anyway.
Yeah, they're. I tell you what we do actually. We there's a play centre near Bunnings in Coburg, and so me and a mate will take our kids to the play centre in the morning, and then we'll walk across and get a sausage. And then we'll stand there just in the little foyer kind of area of Bunnings, making it sound like a fancy hotel in But in the entrance area,
fan.
yeah, they've all got the pictures of all the staff on there and little departments that they're in. The kids go and point to their favourite employees. Anyway, there's the one fella there. He's the barista. He's the official Bunnings barista. But I tell you, if you're looking for room in a Bunnings store, you can absolutely, for car parts, take over the cafe.
Take over the cafe. I mean, Bapcor reminds me of ARB. So the old, I think it was similar.
Pretty poor man's ARB.
Yeah,
but ARB is one of the top performing companies on the ASX. It's incredibly high quality.
Has been better.
Yes.
Like you look at the double peak on it though. Like it peaked at 50 something in 2022. It's still like pumping out. This is the thing everyone thinks it's struggled since 2022 because of share price falling, but it's pumping out stronger and stronger earnings. I think the growth has just slowed down. So I think they're like there's so many companies that are prone to a Bunnings taking over a certain sector. Apparently pet supplies, the count was up before, have done incredibly, like pet food, dog, all those sort of things going through Bunnings now. So
really,
like any conglomerate, it's basically trying to add new verticals because it grows generally at like 2 to 4%. It grows around, not inflation, economic growth. So how do you find other verticals? And then I think so many of these other companies under pressure or at risk of Bunnings or another major supplier jumping into that sector.
But there has been cases. This is why I am kind of interested in Bapcor and the direction that they're going to go in. There are cases where, like if you look over in the US, for example, where ultra niche stores do incredibly well.
Yeah.
Like, so if they've got Lowe's and Home Depot over there, which is the Bunnings kind of equivalents, that are very, very dominant, right? But then you've got exceptional companies like Floor and Decor over there.
Yeah.
They just specialize in one thing.
Yeah.
And if you're doing that, that's where you're going. You know, they cannot, the Lowe's, the Home Depots, et cetera, can't compete. But also then in Australia, you've got the likes of, say JB Hi-Fi, for example, competing with a behemoth like Amazon coming in. JB Hi-Fi has done incredibly well. So you do have these instances of retail outlets, the good ones, being able to fight back and also thrive. So not saying that Bapcor is that, but I think it'll be interesting to watch from that perspective. I think the CEO was the former Australian head of 7-Eleven.
Yep.
I'm wondering, and I've got a question for you on this as well. I was thinking an interesting segment might be, well, not a segment, but an ongoing series. Bapcor's probably small enough, right, that I could email investor relations. And maybe we can do like a little turnaround of a retailer series. Get the CEO in.
Yeah.
Get the CEO in.
They probably love to at the moment. They need to tell their story.
And they're small enough to what's a $1.3 billion market cap. To that they'll probably respond to me now if I
I just looked at the head of investor relations too. So
okay, fantastic. And a bit of an ongoing series where we check in with them once a quarter, once every 6 months, and actually go along for the journey on two aspects: on a turnaround play, which we all know the saying, turnarounds rarely ever turn. Yeah. And also like do a real proper deep dive into a retailer. I think that could be quite interesting. So, Drew, I've got a question. Have you ever had an episode idea that Owen's just flat out rejected or left you on red that you think was just gold?
I usually just bring up ideas on the podcast and then he either blanks them or not. I just can't.
What's your biggest regret that he never ran with?
I'd have to. I mean, most of them are bad. Like, there's a lot of ideas that come out, so a lot of them are bad, and they're very random. Maybe a whole episode on dad jokes. I don't think he was keen on that one.
Jeez,
some kind of fruity ones in there. Honestly, I can't. Well, what would it be? Why I bought? I mean, Fang just came out anyway. A good question for this would be, and how do you segue from this? would be, what do you do when a company falls 40%? So I think it was all the lessons I learned from holding falling knives, which apparently didn't make for great listening. Buy a company that's fallen 30% from its all-time high before it falls another 30% from its all-time high.
So you were going to do an entire episode on all the falling knives you caught.
I've had a few.
You've had a few. What was the worst?
What
what was your decision whether you thought, you know what, in hindsight, that was really, really dumb?
There was an old engineering services company.
What was it called?
Back in the day. I'm not saying the name.
Come on. Engineering services, we talking like mining kind of services, engineering?
Yeah, exactly. And they were constructing a few assets on
contract. Monadelphous?
No, similar idea.
Okay.
Monadelphous is like the ARB to my Bapcor.
Oh, okay. Righty, I'm trying to think.
And it literally disappeared within 3 months of buying it.
Oh, so delisted.
No, it went bankrupt.
Yeah.
The contracts, like fixed price contracts, everything blew up. 3 major projects done. All the numbers, all the the ratios, everything looked amazing, and then bang,
right,
gone within 3 months.
You doubled down.
Oh, I bought it on the way down.
Oh, okay.
Yeah, it's always like, the first earnings, like if there's anything, it's like one earnings downgrade is followed by multiple earnings downgrades. Like and that's always in my head.
I did the same. I'm actually going to say the name of the stock with mine. I did the same with Magellan.
Yeah. Oh, I did the same with Magellan too. That's why it's a whole episode. And Zip.
Well, because I did the same with Magellan. Yeah, because I just looked at it and I thought, geez, they've still got so much funds under management. Their earnings still a good clip on it.
Yeah.
What could possibly go wrong?
We've all done that. Don't worry. And Magellan was it was actually a reasonably easy story to understand. But how people would run from it was hard to fathom at the time.
And the outflows just kept on going, and still are.
Yeah, and then it becomes harder to retain talent. So the PMs start to leave. You have turnover. Your salespeople start like all this thing, and then people have got long held large equity positions that it's hard to actually reset and refresh. And then something like GQG comes in, and these other nimble, lower cost, strong performing, and then bang, and then the whole game's kind of flipped.
And then you're already seeing like places. I don't know if it's Fidante or Pinnacle have launched a fund with a couple of former portfolio managers at Magellan. So like the good people who are maybe not championed as much as they probably should have been and put in the limelight as much as they should have been when you had a rock star style investor like Hamish. Have you noticed though Hamish Douglas has started to appear again?
Yeah, I bought that stuff a couple of weeks ago.
Oh, right. Sorry, I must have missed that episode. I apologize.
No, it was very brief. But it was like, I think the headline was like 70% of the S&P 500 could fall 90%. It was something like that.
It was a big, garish headline.
And the solution was active management. So in that case, you can't hold the index. I was like, in theory, yes, that could happen given the disruption of AI. But at the same time, these companies don't just stop now for the next 10 years. They're all doing a lot of different things to navigate and protect themselves or grow from it as well. So,
what do you think he's up to? Because I reckon he wouldn't have popped his head up into the AFR if he wasn't.
It must be a launching. I think has he got an advisory position somewhere? I believe
he is on the board.
Barrenjoey still.
Potentially. He's on the board at now, which is interesting, and taken a substantial stake in Motorcycle Holdings.
Yeah.
Which is random. And and he's also brought on, I can't remember her name, but she was at Magellan for a long time, kind of like a 2IC. She's now on the board as well at Motorcycle Holdings, which is just seems like a very off-brand investment for him because he's very tech-focused historically and going into a motorcycle physical store roll-up play.
I think you're either going into a private equity, like, that would make sense, having made so much money out of public markets.
Making so much, losing so much.
And losing so much publicly. But I mean, naturally, when someone who was always in funds manager starts to pop up again and their comments around investing, it feels like there's some sort of fund strategy, something coming. Maybe not. Surely you could hang up the boots and you'd be okay, and not have to put yourself back out there.
I think you had a property in down the Southern Highlands, New South Wales. You can go and raise some long-haired cows or something like that and be happy.
And relax and invest in motorcycle holdings and do your own family office. That's probably what I think you'd probably do. And be outspoken about those companies, but I wouldn't go back into active funds management.
Not after the, you'd have to have pretty thick skin, I'm guessing.
So we had another one close. I bring this up irregularly, but there's a lot of fund managers closing down. Yeah. So last Touchstone, which was part of Bennelong, and I think it had $1 billion under management or something, is closes doors, small cap, and hand money back. It's just a super competitive, tough environment.
It is a hard environment.
It's been a great environment for 20 years, but
I remember talking to Steve Johnson not too long ago as well from Forager. Yeah, and I said, and he actually reminded me of another cost that was really impacting smaller outfits was the price of insurance. As well. So funds management businesses are fantastic when the wind is with you, and because you can the margins are just fantastic. However, because you've got that preset kind of cost base with your staff and your service providers and whatnot, but when it turns
so quickly.
It's so quick, and when it goes out of favour, you remain out of favour for a very long time. Just look at Platinum, for example.
Getting these companies to why you like a falling knife is this company's cheap. It's still got assets under management. Look at the dividend yield on Platinum, 7.9%.
And it's a business we understand as well. Yeah, because we're being in that environment.
But then it takes so long for these things to turn around. There's a long list of them: Magellan, AMP, Platinum. Zip.
Perpetual.
Yeah, Perpetual. And you look at it feels like, it'll turn around in 6 months or 12 months, and if there's a catalyst, it'll work, but that catalyst doesn't come, for 3, 4, 5 years, and then you've held onto a stock that's done nothing while you could have just held the index and probably done better. It's that, I think, and this is one of those, cost bias that you have.
The turnaround story as well, it's very much, you could be right. Yeah. But if you're early, it's the same as being wrong.
Yeah. It's like if your stock falls 50%, you have to make up, it has to return 100%. So it has to double just to get back to where you were before. And that's when it's there's usually, if it's performed that poor, there's usually better opportunities elsewhere. And in a lot of cases, we've seen this recently as well, they fall so far that they just get taken out at a much lower valuation to their peak, and you end up behind anyway. So it's
Is Perpetual remaining listed with L1? Is it kind of like a
Platinum?
Backdoor listing essentially for... Sorry, Platinum. Is it essentially a backdoor listing for L1? Is that right?
Yeah, basically. Yeah, okay. It's a merger, but Platinum shareholders being paid in L1 shares, and I think they'll rename Platinum to L1. The company to L1 at some point. There was some complexity around performance fees or earned performance fees or something like that. I couldn't work that out. But basically becomes a listed fund manager.
Yeah, fair enough. Let's get into some questions, Drew.
We have time for those, all right?
Yeah, well, as a long-time listener,
it is in the
as a long-time listener myself, I know because I can see the question spreadsheet. So whenever you guys out there actually submit a question, through the podcast question form, they all automatically pre-populate on this spreadsheet that we've got. And I can see them all coming through from an insider's perspective, and I know how very, very few Owen and Drew actually get around to. So I've picked out two. This one ties back to, of course, our taco trade. This person says, "Hi, lovelies. What's your favorite GYG order? Plus, any thoughts on the company?" So, which one do you want to? Where do you want to start with that?
It depends on the week when it comes to my order. You have those weeks where you're trying to be healthy and you might go like the naked burrito bowl, like at the moment, trying to have a little, drink a little bit less and less carbs or something like that. I'm probably going to get lots of people stop listening when you say that. But like the naked burrito.
When you're going the anti-Andrew Irvine diet and
exactly
and cutting back.
The opposite.
Yeah.
And then if it's like late night, I'm just going full love chicken. I mean, generally love chicken. You feel like it's healthier when you're eating it, even if it's not. But for sure.
Well, you're a lot closer. Your office is a lot closer to ours than to a Guzman and Gomez.
The closest, yeah.
Yeah, I can't remember the last time I had it, but I think the last time I did have it, I got a burrito bowl.
Yeah.
No, I got the nachos. I actually got the nachos. That's right. Yeah, the healthy nachos. So, Drew, as well, do you have any actual thoughts on the business of Guzman and Gomez? Because when it did list, there was no shortage of analysis out there saying
it's overvalued.
It is overvalued. However, it has done incredibly well.
Does that I mean, what was the list? It was like a $25 listing price, wasn't it? And I think it popped to 40. So this chart isn't necessarily fair to Guzman y Gomez.
Oh, it's definitely definitely come back down to earth, hasn't it?
I actually didn't know until this came up that it's off a third from its high.
Yeah,
but I'm pretty sure it listed like $25 though.
Yeah, it's about that. Yeah, so it's
$22 a share. Yeah.
22. There you go.
A year ago, so you're actually up 10%, which is in line with the index over the last 12 months.
It also came at a time when the ASX was completely starved of IPOs.
Yeah,
and the brokers just wanted some action.
Yeah.
Would someone please think about the brokers?
This is an interesting one on, like, I'd like to know if anyone came out of escrow in February. So when you do an IPO, the big shareholders are in escrow. They can't sell for a certain period of time. It listed in May 2024, and in February 2025, it would have been an earnings update, but the stock fell like at least 20% in a session or a day. And I'm always interested to know, and we've seen this before, airlines, retailers where private equity sells them and they hold on for a certain period of time, and then a heap of people dump their shares and it kind of resets the cost base. That's why they say it's overvalued when it's going to listing. But I think, you see this all the time, and it is the only way to make money, I think, in fresh food is to scale up quickly and dominate the market. So I like it much more at $27 a share than at $40, if that's an answer.
Well, I see Mr. Thomas Cowan, big seller on the 11th of April.
Yep.
At 80 million worth of shares. He sold out.
So I think I'd say a mix. I generally hate retail, or like the retail that it requires fast growth. So Domino's, these sort of companies, because you see what you see here is they run incredibly well. They spread. There's same store sales increase while their total sales increase because they're opening more stores. But it's about, if you're depending on whether this has legs globally, because Australia is quite a small market, and things like Chipotle.
There's only so many Guzman and Gomez drive-throughs you can install. I'm still surprised when I see a GYG drive-through.
Yeah, drive-through anything. There's a drive-through coffee shop on my way home. I was like, yeah.
There's actually down the road from me on Lygon Street. There's a drive-through 24-hour florist.
Yeah,
but if you Google it, it's got quite the checkered history. Who needs flowers at 4 a.m. in the morning?
Yeah, exactly.
There was, I believe, and I'm pretty certain I've read an article about this. There was a kidnapping that took place at the 24-hour drive-through florist on Lygon Street. So very checkered history. Yeah. Not saying that anything like that will go on at the Guzman and Gomez drive-throughs. All right, another question has come in here.
Live on the air. All right, here we go.
Not live. Not live. As in, I've got the spreadsheet over here.
So in answer to that, I'm a mixed on GYG. I think it looks much better now. But if I held it at IPO, it could feel like a falling knife.
Right.
That's probably why I like it. So if I like it, that's very simple advice. Yeah.
So the indicator of that is Drew of do the opposite. He's keen on this falling knife.
Avoid for the time being.
So this person's question comes back to us referring to active management before. There's a lot of commentary out there that active managers will not beat the passive index. This person has just picked a few recent examples, though, and wants to know our thoughts on the forward-looking returns. So, for example, ARC Global Innovation, 58% return last year. Ophir Global Opportunities, Australian manager, 41% last year. Hyperion Global Growth, 40% last year. Plato Global Alpha, 39%. We can go on. He's even lobbed in Seneca here at 34%. It's very good company for Luke.
Bit of cherry picking?
Yes, very cherry picking. But, there is a trend here. Forager, Firetrail, Spheria, these small cap managers here in Australia, all very, very high returns. When you see these types of active funds putting up big numbers, are you more in favour of avoiding them or running to them?
I think to reference, if you go to the S&P website, there's a thing called SPIVA that does the analysis of the entire universe of active managers, active global, active fixed income, active smalls. It doesn't. I mean, there's two proper trends there. One is that pretty much all of those funds are hyper growth. Like as soon as ARC is in the conversation, that's a hyper growth.
I wouldn't call Forager's not hyper growth, but that's the outlier in this group.
And then that has as the second part is that a lot of them are small cap managers or mid cap managers. They're not. So what you get there, if you talk to any of those fund managers, they're not saying, I just want to beat the S&P 500 or the ASX 200. These are long term. They want long term significantly higher returns and do something incredibly different to get there. I mean, if you look at Cathy Wood and the ARC fund, I'm pretty sure if you looked at over 5 years, it's underperforming, but over the last 12 months, it's significantly outperformed.
It has it's very boom and bust.
Yeah, exactly. And momentum, and it's thematic. So I think you're always going to see that in thematics. It makes me. I've always been a proponent. I was when I first came into the industry, 100% of portfolios were active management. You had Platinum, you had Magellan, you had Ping, you had everyone in there. And then ETFs came in, and there was this trend to do all ETFs as if you had to do one or the other. And I think for retirees, I think for a lot of people as well, the best outcome can actually be blending them, because even the SPIVA data shows there's certain sectors, like when you actually go into niche, if you go growth, US value, US growth managers, I'd suggest the data is very different to just US broad managers as well. I think it just helps hopefully support the role of active managers in diversifying portfolios. Because it's so easy and almost lazy to just say I'm being a bit out there today. It's kind of lazy just saying, you're never going to outperform, you may as well just buy the index. That's like, you're never going to outperform if you're buying a fund manager that is basically tracking the index. You want someone to be different, and you want check things like active share, their portfolio turnover. So I like it. I think it's good to call those things out when they come out in comparison, but also to keep in mind that they're very niche and specialized. And small caps, we've always used active in small caps because, Owen talks about it all the time as well. It's difficult when you get the more expensive companies as they come up, but then you get the fallen. You kind of get the dogs that fall out of if you just buy the index.
If you just want the index exposure, it's a pretty shabby index.
And it's like, if you look at Australia, I can bring up the SPIVA data for Australia as we stand here. So 85% of large cap Australian equity general funds underperform the ASX 200.
And that speaks to the efficiency of, say, the ASX, the large cap indices.
But also, I want to 63% of small cap outperformed.
Right. Okay. So, and that speaks to, I think, once the inefficiencies of the small cap index as well, and that there are opportunities there if someone's really hunting around because there's fewer eyeballs on them. I'm interested in your thoughts, though. With the large caps. How much of that do you think are these legacy funds that kind of have been around for a very long time? They've got still baked in relatively high fees.
Yeah.
And they're actually not that active.
I'd suggest it would be as much as half of the universe these days. There's just big funds. Maybe they're part of a multi-manager. So if you're in a big corporate super fund, they'll have a multi-manager model, and they've got an agreement with a certain fund manager that the money sits in there. It wouldn't surprise me if like over 50% of the universe, because
if you took out like a colonial first state funds and things like that have been around for a very, very, very long time, they might not even been designed to actually beat the market, you know?
It's basically tracking it expensively, because we couldn't access ETFs when I was first.
But they're still going because there's still people in them, and so they're still viable. But if you actually extracted them, how would that affect that Spiver report? That's something that I'm, fascinated by.
For sure.
One day we might dig into it, but today's not that day.
If you go through a what's it called? If you go through like a Lonsec or a Zenith, so these are research providers that look at active fund managers, you'll find that their universe, which is much smaller of research funds, has a completely different spread of underperformance, outperformance compared to
Spiver, which is just a catch-all.
Yeah, exactly.
With no kind of quality overlay.
Yeah.
Yeah, that's interesting. Drew, I've got this, as this is probably our first and last podcast we'll ever do together. I thought I'd get to know you a little bit deeper. So I've prepared a few rapid fire questions.
Perfect. Can I just briefly, for those listening along at home, the Everything portfolio is up 9.61% as of the 31st of July at recording. The Dizzy Rascals up 5.65, and this is the best one, being Owen, 6.63. So just putting the crow in there, then I'm a clear 3% up.
Yeah, if you were not up, that would never get a mention, would it? So I wasn't actually going to bring it up.
In there.
All right, Drew, some rapid fire questions. What was the last book you read?
Growth Hacker Marketing.
Sorry, growth hacker marketing. Right. I thought for a second Grant Hackett wrote a book on marketing.
Grant Hackett Marketing. No, Growth Hacker Marketing. So written by Ryan Holiday. So kind of big on marketing. And it was just...
is that because you're becoming like a social media sensation or a YouTube sensation over on the Wattle channel?
I mean, if you look at the comments, no. It's more just like with AI, there's so many things that are changing. Permission marketing is another one. I think Owen shared that with the audience as well. But it's like, how do you rethink the way you're marketing yourself, your business in the modern environment? Like just spamming people, sending stuff to people all the time doesn't work. Like it's just, how do you just change your mindset? So I tend too much towards self-help books. So this is more
do
like...
you? What was the last self-help?
Too much.
What was the last self-help book you read?
I read Think Like a Monk.
Right.
Jay Shetty.
Okay.
I'm
not familiar. Sorry, I'm not familiar.
It's he spent I can't remember how many years in a monastery.
Right.
He's incredibly well known.
How's he going now? Is he all right?
Good. I assume he's selling some different things. So.
selling books.
Who knows? It's either self-help or these businessy, and I kind of like these ones. I run through these, and then I read a Harlan Coben book next to it. So,
right. Any fiction?
Yeah, the Coben.
Oh, what is? Sorry, yeah, you threw that out there, but I don't know it. Are you looking at me like I should know it?
No, sorry, I just had someone walk into the pop their head in.
Do they need the room?
As is always nice. No, it wasn't. It was my business partner, so I'm not sure what he wanted. What's the latest one? So here's like the hook and turn. They call it the hook and turn or hook and twist, where they take you all the way along this story, and then right at the end they flip it. Not Think Twice. Missing You. He's very big on Netflix at the moment.
Oh, okay.
I'll track that down.
Okay, send it through. We'll put it in the show notes. Right. Last movie you watched. Last movie you actually went to the cinemas to see.
Ooh, I wanted to see F1, but we had to cancel that at the last minute. It Ends With Us.
Okay.
Not the movie you probably want to see at the cinema on a date night. Right. But yeah, not to make light of the topic of that movie at all.
Right. Best restaurant in Melbourne or favourite restaurant in Melbourne?
Now, I've been caught out with this before because someone asked me the question. I went naturally to the really expensive ones. The ultimate favourite, it's actually outside of Melbourne, would be Tedesca.
In Red Hill?
In Red Hill.
Yeah.
Yeah. Amazing food. Like a long lunch.
Is that where you go for your Wattle days that I don't get invited to?
No, I wish. We have like 80 people and they only seat 25 or 30 or something like that. In terms of inner Melbourne restaurants, Poodle would have to be
Poodle on Gertrude Street.
Yeah.
Right, yeah. I've still not been actually.
I don't think I've sat for a whole meal there, but at the bar they do a half teeny. So if you're, watching the NAB CEO kind of story,
Andrew Irvine, get there, mate. Only half teenies, you'll be right.
Too many martinis is hard. So they would actually do a half glass of martini, which is, that's about a perfect amount. But the food is like exceptional there. Otherwise,
I'll have to go. Yeah, I've walked past Poodle a lot, but I've never actually been in.
And then Kasume,
cool.
Yeah,
very good. Finally, mine.
Banh Mi stand. I love Banh Mi stand too.
If I'm in Melbourne and if someone is visiting me, I'll always take them to Embla, and we'll sit at the kitchen bar. If it's just two of you, just sitting there at the kitchen bar, and you're 30 centimeters away from the chefs and the big flaming fire oven and stuff like that, and it's dinner and a show. And the food's great.
Deliberately don't say that because I don't want anyone else to go there.
Yeah. It's under the radar. So luckily no one will be listening to this because we've waffled on for a very long time.
That would be my top one.
Yeah. It's
Embla for sure. The wine list is ridiculous.
Is the best. Yeah. The best by the glass wine list getting around.
I found there's a story there, which is there was a wine on their wine list. We got the last 2 bottles. I asked to find it. I managed to track it down like a Swiss wine shop.
Swiss wine shop. You don't see many of those.
I found the bottle because it was so in Switzerland. Like I had to get it sent here, and then visited was from Burgundy, so visited Burgundy, and managed to. The winemaker was friends with the receptionist at the hotel we were staying at, so we managed to get a tasting with the guy whose wine we tasted in Embla.
That's awesome.
A year later, it was
just a little insight, everyone, to how the other half live.
That's what we do at the end of the show. Damn it. I thought I was being personable.
Sorry. Well, it was very personal. It's great. No, it's wonderful. I've only ever stood in paddocks I have had a fantastic wine tasting in just outside of Beechworth, actually. And we actually got to stand in the paddock by the winemaker set up this table by the dam and everything. We were charging.
Could not be Giaconda.
No. It was.
There's a special winery up there that I ran into when he was working out of the asylum, the old asylum on top of the hill.
Right.
Fighting Gully Road.
Oh, yeah. I'm familiar with that. Yeah. This was. It's really annoying me now. Anyway, I think we've banged on too long. So everyone, thanks for joining us. I promise you Owen will be back next week. He'll be off his deathbed. And Drew's portfolio will probably be back down to earth.
And I do have a dad joke for you as well.
Oh, yeah. Sorry, go on.
I thought would fit in with this week is what's smarter than a talking cat?
Don't know, mate.
A spelling bee.
Oh.
I was just trying to get the connection with the cat on the test before. Yeah.
He's sitting over on the lounge now. And I've just remembered the winery. It's called Schmolzer and Brown. It is fantastic just outside of Beechworth. So, excellent, Drew. Thanks, mate. I'll let you go and get on with your day. And everyone else, enjoy your weekend.
Amazing. Good to see you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.